Hey everybody, hope all is well. I'm going to continue this series on paying for long-term care. In the first session, we kind of gave you the statistics on what's going on out there. The second session, we talked about the public resources. And now in this episode, we're going to talk about the products. And really, there's three primary products that are out there to help you fund and pay for long-term care with your own resources. So let's jump in and generically understand what types of products these are and the good and the bad of these things. So traditional long-term care insurance. This is not any different than auto insurance or home insurance. It's considered a risk-based insurance, right? We pay and pay and pay and hope we never use. And if we don't use, the insurance company keeps all the money. And it doesn't seem fair. We've seen almost all of the major insurance companies exit this type of insurance product. There's only a handful of legitimate insurance companies out there that are still offering this type of long-term care insurance. This is simply an insurance you pay a premium for, and if you need to pay for long-term care, they will then start paying you monthly or quarterly or reimburse receipts, things like that. The problem that we have found is that, first of all, the insurance companies mispriced cost, right? But they also realized that the more they make it difficult for you to get money out, the less money they end up paying, right? You go into long-term care, if it takes you 6 months to get them to start sending you money, then you have 6 months less of life left. And they understand that, and that's why there's layers of difficulty to try just to get money out. But they've also realized that they can change the terms of this type of insurance. Insurance that you are still paying for, they can raise the rates, they can alter the details in the contract. So traditional long-term care insurance, all but gone. A lot of people own these policies and need to understand what to do with them. This is always a conversation about your whole situation. And so in the fourth episode of paying for long-term care, I like bringing everything together and taking that step back and looking at our own financial situations and deciding whether we need things like this or not. Products don't always have a place in people's portfolios. So traditional long-term care insurance, the most conversations I have about that is people that have been paying on it and paying on it and paying on it, and they keep raising the rates, and they're starting to wonder, should we be paying on it? Chasing more money after bad money is not a good idea. I call that sunk cost. So annuities, we had a bit of a shift back when the Pension Protection Act came in, I think 2006-ish, which really affected life insurance. But there are special medically underwritten annuities out there that will pay out payments to you for life. As long as they're paying for long-term care, they'll be tax-free. But those are far and few between. We don't see anyone actually using those. So the annuities that actually get used properly sometimes are, unfortunately, the ones that get most sold in dinner seminars. Deferred income annuities, when used properly, can be a great boost to income later in life to help pay for that increased expense. And so for a lot of people, it's just simply stocking away some emergency money, $100,000 or $200,000 earlier in life, maybe in your 70s, into a deferred income annuity. And then it can sit there and grow in deferral on a guaranteed basis. And that really becomes powerful, because let's say in your 80s, you go into long-term care, you can trigger a lifetime of income, and it's a withdrawal benefit. So God forbid you pass away a few days later, your heirs still get the value that's left in that contract. That's the nice thing about this type of income annuity, is the cash value is still there if you didn't receive all the money. But even better, that single payout guaranteed income it can double if you're confined to a facility, or a lot of companies are now starting to do just a doctor's letter for 2 of the 6 activities of daily living. So there's a lot of options out there. And this, if you're just stocking away a little chunk of money, I've seen people put it in CDs, especially right now. I've seen people just kind of squirreling it away, and that account is just in case I need long-term care. Well, there are some decent annuities out there that maintain that cash value, but leverage it up as a form of income and have growth parameters on that income that can be pretty powerful when used properly. And then if you don't need long-term care, all the cash value goes straight to your heirs. So not a bad option for some people if you just need a boost to income. I see this quite often when maybe you've got, as a single person, $3,000 or $4,000 a month income. You're above what Medicaid allows, but you're below what most long-term care facilities require for payments. So that's where this boost of income really helps out. You stock away an extra $100,000 or $200,000. It gives you a nice little boost, $1,000, $2,000, $3,000 a month income, depending on how far in advance you're planning. And then there's life insurance. So this was where the Pension Protection Act of 2006 really made some significant changes, and what really was the launching point of traditional long-term care insurance disappearing. I think the whole world realized that life insurance was going to be much better suited to help pay for long-term care, and it's real simple. Everybody knows what life insurance is. We pay money in, they guarantee a death benefit. If you pass away, your heirs get a tax-free lump sum of money. That's what it is, right? We've protected our heirs in our younger working years. We want to protect our family. If one of the parents pass away, we're going to lose income. Maybe it's used to pay off a mortgage, put you in a better financial situation if a parent passes away. That's the most traditional way. And then people start using it to transition and pass wealth to heirs. A lot of I call them the mid-wealthy people, those 3 to 5 million on up to the $40-50 million net worths. A lot of them use life insurance to pass wealth to heirs. So there's a lot of use for life insurance. Well, now the death benefit itself on guaranteed life insurance, universal or whole life, guaranteed death benefits can be paid out before death, as long as it's being paid out for long-term care. And that's the neat part of this is, think about this from a life insurance company's standpoint. They were just given a whole bunch of tax incentives and authorization from our IRS to allow them to pay out the death benefit early before death. And they can discount it and get a bunch of tax benefits to do it. So they're incentivized to pay out some of that death benefit before you pass away. So now we don't see people having a hard time getting money out of these types of policies, nor the annuities. The annuities are built to pay a payment to you for the rest of your life, whether you're in long-term care or not, right? Life insurance is the same way. Death is inevitable. They know they're going to have to pay out that death benefit. And so having an incentive to pay out a discounted version of that beforehand actually helps the insurance company. So now everybody's in a win-win situation. But the big part that I like about this life insurance long-term care is you go get a life insurance policy, women get charged less for life insurance, period. Women live longer than men. But women are also more likely to be in long-term care. Women live longer in the disabled state. Men don't live as long as women. So we end up seeing a lot more women in long-term care, and this is cheaper. The traditional long-term care insurance is more expensive for women, and it is harder and harder to get it. Life insurance is cheaper for women, and it pays for long-term care. So this is a win-win situation. Life insurance, I think, from a product standpoint, is the perfect place to start. If you're healthy enough and can qualify for permanent life insurance, if you didn't need long-term care, your heirs still get a tax-free death benefit. I think that's where you typically start, but you got to be healthy. And I always say in your 60s is the best time to look at that. And people in their 60s do not think about paying for long-term care on average. That's the big problem. So then you get to your 70s, life insurance isn't as good looking, let's say. And so then the annuities, the option of boosting the income later in life starts looking appealing. In your 70s is a good time to look at some of those income annuities, but specifically for that reason, right? That's important. There's nothing wrong with annuities. There's nothing wrong with life insurance. It's just making sure that we use them properly. That's the problems that I see out there. They're getting sold to everybody with no plan, and nobody knows how to use them properly. If you use them properly, they can be great tools. So hopefully that helps with the products and understanding kind of our choices. I have a video, if you haven't seen it yet, coming out on those income annuity type products, especially right now with interest rates higher. They're actually somewhat appealing, and this is honestly the first time in 20 years that I can say that. So make sure you watch that video as well, and we'll link it to follow this video if possible. All right, thanks again. Shoot us an email, give us a call, share, like the video if you like this series. And certainly comment below. I'm always happy to answer questions or come up with new videos out there. See you next week.